New tariffs on Chinese goods are pushing product prices higher and forcing many U.S. importers to halt shipments. The Port of Los Angeles is now forecasting a one-third drop in cargo for next week compared to last year. Joining us right now is Gene Seroka. He's the Port of Los Angeles Executive Director. Gene, those are some big numbers. You're really expecting a third of the traffic to drop off next week?
Good morning, Becky. And yes, that's right. According to our own Port Optimizer, which measures the loadings in Asia, will be down just a little bit over 35% next week compared to last year. And it's a precipitous drop in volume, with a number of major American retailers stopping all shipments from China based on the tariffs.
Yeah, the China piece of that is the most interesting. That's where the shipments are basically ground to a halt, you've said?
Yes, that's correct. And that makes up about 45% of our business here in Los Angeles, Becky. Now, what we have heard in talking directly to CEOs and senior executives of the shipping lines is they'll try to add a couple of port calls in along the Southeast Asia routes where cargo is still moving, albeit at a 10% tariff. But realistically speaking, until some accord or framework can be reached with China, the volume coming out of there, save a couple of different commodities, will be very light at best.
I was looking at the numbers, and for the first 3 months, you handled about 2.5 million import containers. That's up 14% year over year. So how much of that was retailers and others trying to really bring forward as much as they possibly could ahead of these tariffs?
A great majority of that volume was advancing inventory, and that started last summertime. Even during the campaign trail, when folks started talking about tariffs and trade policies, some larger retailers across a variety of sectors and manufacturing folks who were bringing in parts and components started to advance that inventory. So we had about 9 months of a run-up here. And then this last burst in March really took us to the end of what we call that inventory look. And now, precipitous drop overall, and realistically what we're going to see next is that retailers have about 5 to 7 weeks of full inventories left, and then the choices will lessen.
Meaning that we could see empty store shelves, meaning that consumers will see higher prices. How do you see that playing out?
Yeah, a little bit of both. And I don't see a complete emptiness on store shelves or online when we're buying. But if you're out looking for a blue shirt, you might find 11 purple ones and one blue in a size that's not yours. So we'll start seeing less choice on those shelves simply because we're not getting the variety of goods coming in here based on the additional costs in place. And for that one blue shirt that's still left, you'll see a price hike.
Gene, we always use the numbers, not just at the port, but any of the transportation numbers, anything that show us shipments coming in as an indicator of the overall economy. The numbers that you saw in the pull forward, does that mask what the situation could be right now? Or, I'm just trying to figure out how to read the economy at this point. We brought in a lot to try and prepare for this. Is there the chance that we'll be able to shift to, containers coming out of Cambodia or Vietnam or other places that will bring that in? I don't know how we read any of this stuff.
Yeah, Becky, you're right. And what we will see are a couple of stops in Southeast Asia to profile the vessels that are still in motion, meaning that, again, a great majority of the cargo is coming out of China. It's not now based on this pause by American importers. So those ships are idling. Let's put a call into Haiphong or into Ho Chi Minh City in Vietnam, drop into Southeast Asia before coming here to Los Angeles, and try to fill the vessel up as much as possible. But the real key indicator that I've been looking at is for the month of May arrivals, we'll see 20 canceled sailings. That's about a quarter of the normal arrivals that we have, and therefore this drop will continue throughout the next month.
But could we make up for it again with places? You've seen a drop in 20 containers, 20 shipments that come in. Could you see additional ones that are put on as they source other countries and try and bring those in? How long do you expect that to last?
Yeah, possibly, Becky, but from a sheer volume perspective, manufacturing capacity in Southeast Asia locations, you're not going to make up for that 45% of the business that emanates from China. Secondly, this is kind of a longer game than transactional business. For example, Major American retailers put their orders into factories in Asia 3 or 4 months before a vessel even sails our way, which is an additional 2-week transit time. So simply shifting from your manufacturer in China over to Cambodia, Vietnam, Indonesia, that quickly normally doesn't happen. There are some negotiations that have to take place in addition to finding the necessary capacity, because a lot of folks are running to these locations now to try to augment the loss of volume coming out of China.
No question that's going to create some pain here. But for China, I've read that they are, in a lot of cases, simply shutting down the factories, not doing anything because they don't want these orders to have nowhere to be sold. I would imagine the pain is felt pretty severely there as well.
That's right. And again, to coin the phrase that's been used most of the morning, nobody wins. China is America's factory, and without these orders, people aren't going to those manufacturing facilities. Truckers, transport people, even the folks in the shipping line industry are scrambling to try to find use of those assets. So yeah, the pain is felt on both sides of the Pacific.
Gene Seroka, thank you. Gene, it's good talking to you. It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. The futures this morning are looking up for the Dow, at least. It's indicated up by close to 160 points. S&P futures are basically flat. The NASDAQ is off by about 26. Treasury yields are near where we were trading yesterday. Right now, the 10 years at 422. The 2-year is at 370.